Good afternoon and welcome to Tax Tuesday. This is our bi-weekly program here at Anderson to help bring tax knowledge to the masses, as Toby always says. I'm Elliot Thomas, Manager of Tax Advisors here at Anderson. Toby's out today and Jeff is out, but they'll be back. I'm joined today by not really an unfamiliar face. He's been here the last couple times. Kurt Bergford, CPA. Kurt, you want to introduce yourself?
Hi, everyone. My name is Kurt Bergford. I'm a tax advisor here at ABA. Just looking for a great show today, help bring in tax knowledge to the masses.
There we go. And I think he's joining us from out on the West Coast. He goes a bit between there and Utah, so a bit of a traveler on our team. And you may have seen him down at the Orlando event recently if you were down there. He got a chance to meet a lot of you, is my understanding. Got asked a couple questions when you were down there, did you, Kurt?
Oh, yeah, plenty of very interesting questions down there in Orlando. So that was a lot of fun. Can't wait for the next one.
Yep, the tax people tend to get swamped, and Kurt is certainly no different. Wonderful to have him here and be here with him. Anyway, getting on with the program here. Just a few reminders about some of our rules. You can ask questions live here through the Q&A section, and we have several of our colleagues on staff here today answering those questions. We have, let's see, Dana, Jared, Ross, Tanya, Troy, all from different departments, bookkeeping, tax advisors, etc., from nonprofit department, attorneys. So Sergey is going to be here in a little bit. So we got a whole bunch of people back there to help out. Of course, we have the live staff here, Patty helping out, and Kenny and company all helping us out here, and Matthew. So we thank you for joining us today again. And you can, again, put the questions to the Q&A section in Zoom if you're on the Zoom, as well as you can email questions to taxtuesday@andersonadvisors.com. That's where we pick the questions from. We try and get the level them out to what are the topics that most of you are asking about, as well as some that might be a little bit unique that we don't get asked a whole lot about. We also understand that we have a lot of clients who are in real estate or stock, so we try and put a fair share of those in there as well. So we'll get through our questions we have today, but feel free to submit them there through the email as well. If you need a more detailed response, you will need to become a platinum or tax client. We certainly want to help out if we can on these, but remember, this is a free service, so there's sometimes only just generalities that we can give through this service, but we want to help however we can, but sometimes we might need you to become a client to do so. So we try and make it fast, fun, not always fast, but fun and educational, just a way to give back to you clients and show our appreciation. And again, something we do every 2 weeks here. We are on episode number 196, and just getting into the questions, we're going to hit straight to the questions. But first, just a reminder, we have a lot of YouTube activity from our partners. Toby being one of the founding partners, he's got his YouTube channel here, and you can join up here through his YouTube channel. He's got tons of video and content, always adding to it. So something to keep in the back of your mind. Clint has one as well. You can subscribe on YouTube here for the latest, aba.link/YouTube for your replays, and this will be up there as well for your platinum clients, replay of this Tax Tuesday. Now, getting on to the questions. You ready to go, Kurt?
I am, absolutely.
All right, so let me read the first one off here for you. All right, number one, if bonus and accelerated depreciation were taken in 2022 via a cost seg on Schedule C, how many years does the IRS require that the property for the property to meet the active short-term rental criteria after the fact? In other words, since that depreciation was taken up front in year one, is it reasonable to expect the IRS to require to maintain that status? But at some point, what if the real estate business needs to pivot to a long-term rental or something of that nature? What happens to that tax treatment in 2022? Any idea there, Kurt, what we got going on?
Yeah, so it looks like you have a short-term rental filed on Schedule C. You took the depreciation in 2022, so that's all very fine, well and good. But then maybe next year, the intent changes, your business plans change, anything can really change, and maybe there would be a need to pivot that short-term rental into a long-term rental. So there really is no requirement for you to keep it as a short-term rental from year to year to year. It's a tax year by tax year determination. So if you meet the qualifications for that in 2022, that's fine. You meet the qualifications for 2022, and whatever happens in 2023 really has no bearing on what happened in 2022. So say in 2023 you did pivot to a long-term rental, that house, that short-term rental would just pivot over to a long-term rental. You change where it gets reported. Instead of the Schedule C there, we'd probably be looking to have it reported where typical long-term rentals get reported. That's Schedule E. And the adjusted basis for that property should carry over to Schedule E. So really not too much would change for 2022, but if you did change your intent later tax years, 2023 or beyond, we would just report it a little differently on your tax return.
Exactly right. So really, I could go out there, buy a property kind of towards the end of the year, maybe get that short-term rental activity, get that big depreciation in 2022. And then Kurt, you're saying that, fine, we got that nice write-off in the first year, even though we had a short period of time. And then the next year we can go ahead and turn it into a long-term. Maybe it's passive. We don't maybe care as much because we got the heavy write-off in the first year with maybe bonus depreciation. Is that correct?
Exactly. Yeah, that's exactly what I'm saying. Take the write-off in year one, meet the requirements in year one, if that's 2022. And then, if your intent changes, you want to acquire another short-term rental and kind of do the same strategy in 2023, that original short-term rental in 2022 could just become a long-term rental and kind of just lessen the burdens of requiring to materially participate in that long-term rental in years going forward.
All right, great. And it is a strategy we've talked about a lot here at Anderson, and a wonderful question. All right, thank you, Kurt. Getting on to the next one. All right, we have a 2-member LLC, taxed as a sub-S, or just commonly known as an S corporation, 2 members, which would be shareholders. Each member/shareholder contributed a substantial amount of money of capital over 4 years. So they're putting a lot of money into this S corporation, both of them, he or she. Can a member be bought out tax-free by the LLC by giving them a sell price in the form of capital distributions? What say you, Kurt?
Yeah, so when we talk about that one, when we're talking about actually buying the S corp, buying out that shareholder, that member's ownership interest in that LLC, you'd probably be looking something at a stock redemption. And when you redeem stock as a shareholder in S corp, whatever price you get paid to redeem that stock is going to be your proceeds from that redemption. So it would kind of determine what your basis is in those shares to determine if you had a capital gain or not. But if the LLC were able to buy out at that interest at something similar to the value that you actually put in, it said you had made capital contributions over 4 years, so it's very possible that you have pretty substantial tax basis in your shares. It's very possible it could be tax-free, but keep in mind the redemption of those stocks should be close to fair market value. So kind of depends on the assets that we've contributed, what the assets have done within that S corp thus far. But it's certainly possible that it could be bought out tax-free.
Very good, excellent. So it's really no different than just selling any stock. In a sense, you're going to get a sales price or the redemption price back, and we subtract out that basis that we have, which in this case is your shareholder basis in that stock, and that's how we determine if there is any gain. So as Kurt pointed out, if that amount happens to be equal to whatever our basis was, or shareholder basis, then it's possible that there'd be little or no tax on it, certainly. All right, excellent. Next question. If a medical procedure is performed in Mexico, can you use your health reimbursement account from your C corporation?
Yeah, so again, I'm not unaware of any specific rule or regulation prohibiting a medical procedure being performed in another country. You got to keep in mind though that if you're going to, a foreign country, there should be, it shouldn't be that you're necessarily going on a nice vacation to Mexico, and you just happen to be getting a medical expense done there. The actual medical expense certainly could be deductible anywhere, but when we talk about other types of auxiliary medical expenses, like the lodging, things like that, that is kind of where we got to be a little bit more careful about what kind of deductions we're taking. I think the IRS says there should be no significant element of personal pleasure, recreation, or vacation in the travel for getting those medical expenses. So you just want to be a little careful with that, but you certainly can have a medical procedure done in a foreign country and use your health reimbursement account to have that reimbursed and deductible by the corporation.
Perfect. And just before we get excited about maybe having that trip so that we could have, as Kurt pointed out, maybe even a hotel portion being paid by that, it is limited to $50 a night. There's other stipulations and things like that. So we probably don't want to get that 5-star hotel just yet if we're doing something like that. Want to keep it related to that, that medical procedure, and certainly can't be cosmetic as its sole purpose. It really has to be for the prevention or cure or significant medical problems, probably definitely done by a licensed medical professional. All right, and that is a big area of the things that we talk about. That medical reimbursement plan had a few questions that came in during the last 2 weeks for Tax Tuesday for that. So we actually have another question kind of along the lines of our health plans and things like that. Is there a list of IRS allowable healthcare expenses that can be reimbursed under a Section 105 HRA health reimbursement arrangement, which is what we often set up with RC corporations? There are defined lists of allowable reimbursements for HSA plans and FSA cafeteria plans, but I don't see an IRS specific list for 105 plans. Does the employer have some latitude as what can be reimbursed? Where do we go to look for what we can do on our 105 plan?
Yeah, so when we talk about what's allowable, certainly things that would be allowable under HSA and FSA plans are what we're going to first look at. But we're also going to look at what else might be deductible if we hadn't got a reimbursement, we just paid out of pocket, and tried to take that medical expense on our Schedule A on our personal tax return. So in that case, the IRS has a great publication, it's Publication 502. All you got to do is Google that, Publication 502, and it'll kind of give you a list of commonly deductible medical expenses that, they go through almost any kind of medical situation that you might have. And that's really handy publication to keep in your quiver to, if you have a question on whether it's something deductible or not, head right there. And, for us, when we talk about what is deductible under a Section 105 plan, that is usually what I would kind of look towards to see, is this specific medical expense deductible first? And if it's deductible there, very good chance that it would be able to be reimbursed under the 105 plan.
Very good. And just as a rule of thumb, I often, some of us will tell the clients, if a medical professional, if it's something that they have prescribed or treatment that they have requested that you get for some, again, prevention or curing of some medical condition, then more than likely you're going to fall in there, because even the 502, it's an expensive, that publication, it's an expansive, list of different things that can be done. It's certainly not exclusive. There's a lot of other things out there, I'm sure, that aren't in it, but it is certainly a great resource to look at. It's one that we look at often and to try and guide clients. And excellent job. All right, next. I purchased my first short-term rental property last year and have spent a year fixing it up, but it's still not out as a rental. Can I write off my expenses from 2022 for a business that isn't making revenue yet? If so, how? There's no LLC started yet, so this would be on my personal taxes for now. So Kurt, I got a property that I'm setting up for rental. I'm not done getting it placed into service. I'm still working on it. What can I do for expenses, if anything?
Yeah, so it looks like you have a rental property, fixing it up, not quite in business yet. So usually we'd be looking at that, is it available for rent? If it's not available for rent, usually we might be able to take simply the organizational costs associated with kind of getting that business up and running. Probably not the startup costs, and most likely when we talk about the short-term rental, what really is going to be valuable to you is that depreciation component. So because the rental was not operational, was not available for rent by the end of the tax year, usually we're going to be kind of limited to being able to start to depreciate that short-term rental. So there might be some availability to write off some of those expenses, maybe just those organizational costs. But commonly, a lot of those expenses will be started to be able to be deducted in the year you actually place that short-term rental in operation, which would be 2023.
Very good. Now, that is an oft asked question of us. Hey, I don't have any revenue yet. Often people associating the production of revenue with being maybe the start of some tax event. The only thing that starts is that you will have to pay taxes if you do have net revenue. But that's not what we look to whether or not we have to do a return, or if a loss indeed would come up, or if it's placed into service. Those are all different things that we would look at. And as Kurt pointed out, with a rental, be it short-term or long-term, we don't do anything with it until it's actually been placed into service. That's when we'll start to have that activity showing up. Very good. All right, moving on. I share ownership of a single family rental property 50-50 with a relative. Excuse me, I think this is one that you were going to handle, Kurt, on that.
Oh, yeah. Yeah. So I share ownership of the single family rental property 50-50 with a relative. Okay, sounds good. The other owner has not been involved. All right, very fair. If I buy her out, step up in basis, or if she passes her ownership share to me by gift, then will I be responsible if I sell the property down the road for any depreciation that she may have claimed on her tax returns while she owned it? So that is a good question.
Yeah, it's a wonderful question, and we do get this from time to time, and it does depend on which option we're going here. If one sells the interest and the other purchases, as Kurt pointed out, we're going to have a taxable transaction there. He mentioned stepped up basis going on there, but the key to the depreciation here is that I would simply take, if Kurt and I had a rental and I bought out his share, I'm simply going to take over the property, but I probably sold it, or he probably sold his interest at a gain of some sort. And if he recognizes gain, then he is going to have depreciation recapture at that point, on depending on the amount of gain. And the way depreciation recapture happens, if you have gain, the first top portion of that capital gain will be subject to depreciation recapture, $12.50 typically, or it could be $12.45 if we've done a cost seg. And up to that amount of depreciation taken, that first top of the capital gains, the initial capital gains, will be taxed at that higher rate. And then the rest would be just true capital gains, maybe 15%, possibly 0, or 20% more commonly, something along those lines. But there will be depreciation recapture for, excuse me, for the partner in this case that sold their interest if there was a gain. Now, if it was sold right at the amount of their interest in the partnership, then there wouldn't be any gain. Very similar to what Kurt was talking about earlier in the earlier question of the S corporation. It is possible to have an amount that is equal to the partnership interest, outside basis we call it, and therefore there would be no gain. If there's no gain, there's no depreciation recapture, and the purchaser would not have to worry about that portion. But on the other hand, we talk about, well, what if we gifted something here? If Kurt gifted his interest to me, then I, as a recipient of that, would have to worry about depreciation recapture later on if I sold it. So to our questioner here, in the case of buyout, no depreciation recapture to be for the person buying, But in the case of donation or gifting to the buyer, we'll say, then there is depreciation recapture later on upon the sale of that. All right, an interesting question there. Moving on. Next. All right. Yeah, just a reminder. Yes, Clint Coons. He also has his tax and asset tax and asset protection workshop. You'll often see Toby in there as well. This was the event that they did down recently, and we were talking about in Florida not too terribly long ago that Kurt was at. Looks like we have some one-day event coming up on June 15th. It's free online for the online portion, and then another one on June 24th, 2 weeks later. So be sure to get there if you can. Even if you've been to them before, it doesn't hurt to get back in there. A lot to learn about it. They always try and update these things as well, maybe with some new data if anything else has come up. But always good to get in there and kind of and hear it again sometimes. Also, just reminding, we also have that structure implementation series out there that you can check on our website if your clients, platinum clients that is. That's another great way to learn more. But here, our bread and butter tax and asset workshop protection. Clint gets into all that asset protection, so very important to learn about. Toby comes in talking about the tax side of things. So it's really a wonderful event. Hopefully you can make those events on the 15th again and on the 24th. All right, going on with the questions. Me and my partner purchased, renovated, and set up a property in Houston for short-term rental. We have a 50-50 LLC, looking at a partnership, it looks like. We've never partnered before. How do we separate the expenses and income? How do we file? Kurt, I just got in this venture with somebody, maybe with you. What's going on? How does this handle? How's the income, expenses? How do they all get handled?
Yeah, so when we talk about separating the expenses and income, with that LLC, all the expenses and that all the income and expenses are going to be recorded on that one LLC. Because that LLC is a multi-member, and presumably when you say your partner, that's kind of a business associate or something like that. Any multi-member LLC is actually going to be taxed as a partnership. So when we talk about how to actually separate that out, the LLC in question will report its income from the short-term rental, all the expenses on that short-term rental, right on that partnership tax return form 1065, and along with that filing, the 1065 will issue each partner, you and your partner there, K1, which will kind of detail your 50% of the income and your 50% of the expenses, and similar with your partner. They'll get 50% of the income and 50% of the expenses on that form K1. And then you'll use that form K1 when you go to prepare your personal tax return, and you'll incorporate that K1 into your personal tax filing so that you're in effect getting 50% of the expenses and 50% of the income. But there is really no separation on the LLC level. It'll all go on that one 1065 filing, which in the process of doing that filing will issue that K1, and then you'll use that to prepare your personal tax return.
And just to throw out just a little bit of a curveball that sometimes we get on when we talk about a partnership like this, Kurt, probably an unfair question, just throwing it out here, but ever a time when maybe on a partnership, we might be able to allocate differently for some reason or another? Have you ever run into that at all? We talk about it sometimes.
Yeah. Sometimes, there might be a reason to specially allocate income or expenses differently among the partners. Depends on kind of, who's doing what. Maybe one partner is just putting in the capital, maybe one partner is putting in the sweat equity. You certainly can make an agreement with the LLC and lay that out within the LLC agreement to apply the tax attributes differently depending on how the partnership is made up and kind of who contributed capital, who contributed services, things like that, that might kind of change the nature of how much income or expense, or which specific income or expense items get allocated to each individual partner. But when you're going to do that, make sure that you have that agreement in writing. And the key there is that it makes economic sense. Just because Elliot put in all the money and I put in all the sweat equity does not mean that I'm entitled to certain deductions and he's entitled to certain incomes. It's got to kind of really make economic sense when you kind of look at it from a holistic point of view. So that's just one thing to keep in mind.
Excellent. So certainly something that can be done, and we do get asked that a lot because a lot of the great examples that Kurt just gave there, maybe someone put the house in, other person did all the work, maybe they want to give all the depreciation to the one who put the house in. That can be done. Now, it's something that, again, as Kurt cautioned, you don't want to just go out there and do, and you want to have language in there about this substantial economic purpose or reason that you're doing it, that it makes economic sense, et cetera. So there are some particularities to it, but it is, while generally we like to see if it's 50-50, we want to see things split, as would normally be the case amongst that profits percentage. There are avenues for that changing around, but it's not something to be taken lightly. If the IRS sees it, they're going to want to come and say, see why we're doing that, and you want to have that, as Kurt pointed out again, the reasonings to back up how it was being treated on that return. Excellent. All right, moving on to the next question. All right, I'm a 77-year-old newlywed. Congratulations. My husband has a trust for his family. Do I need one for my family, or is a will sufficient? You ever hear anything about maybe how the partners think about that, wills versus trusts or anything like that? Ever run across your desk there, Kurt?
Yeah, so, if you have a will, that's always a good starting point. However, a will can be contested. Often, when we talk about what is good, better, best, having a living trust by placing all your assets within the living trust. So it's very clear to when you ultimately pass, where you'd like your assets to go. And that's very clearly laid out. That usually is a better bet. And the reason we usually like that over a will would be that, a will is going to be something that can be contested. It has to go through the probate process, where a living trust, you're actually just strictly directing where those assets go. Saves a lot of money on the probate costs. I know that, before I came to Anderson, I had a situation where a client didn't have a will or a living trust, and there was some significant amount of assets. And some states actually, I think we were in Connecticut at the time, they actually charged to administer the probate estate actually a percentage of assets. And this client had a large amount of assets to go through probate. And the probate was incredibly expensive for that client. So not only professional fees to administer the entire probate, but also on the court level to administer the probate through the court was just an unnecessary expense that could easily been avoided if the client had a living trust. So always a pretty good idea for something like that.
Excellent points. And yes, Kurt's exactly right. I used to work for a law firm that did that quite a bit. Had a lot of will activity coming through. Trusts just really weren't used a whole lot at that time. I'm a little bit older and was quite a bit younger when I was working at that particular firm. And it is an added expense, just as Kurt pointed out, one that you can avoid. And it's not to say, and it certainly cuts down on the red tape, not going through probate, or at least limiting anything that would go through probate. It doesn't mean that there's not quote unquote red tape with a trust, a living trust. There's a lot that has to be handled sometimes with that as well. But it's certainly, I think we can all promise you that it's certainly a lot easier through a living trust. And, unfortunately, when those things are being in use, it's usually a kind of a tough time to begin with. And you probably want to make it as easier on you as possible, or your heirs, your beneficiaries, I should say. And so we highly recommend using that living trust, always to just kind of set things straight and not leave it up to the courts, and maybe a lot cheaper for your estate overall than going the will option. So certainly the living trust is something, revocable living trust, get it set up. And we do those. Certainly we have Sergey, who's I think on here answering some questions. Maybe he might be in yet. He handles a lot of them. Maybe he's not. He's probably doing one right now. Anyway, very good. Thank you, Kurt. Getting on to the next question. I wanted to know if I can write off any stock trading education through my LLC if I pay myself a W-2 and have 401k deductions taken out and put into a self-directed solo 401k plan. I am the only employee. I want to start learning about covered calls and so forth. So maybe we have some education with trading. I guess it doesn't really even matter what the education is. How do we work that with a C corporation, or excuse me, with an LLC, Kurt?
Yeah, so in this circumstance, it might look, it might be a good idea to start looking at what we often set up for people looking to get into the market, kind of what's called a trading structure, an LLC taxed as a partnership, where you are one of the partners in that LLC, and then you also have maybe your corporation partner with you in that LLC. And maybe you have kind of maybe a 90% ownership, maybe the corporation has a 10% ownership, and the corporation's actually serving as the manager of that LLC, and the LLC actually holds that those brokerage assets, actually does that trading activity. And what that's going to do is allow that corporation, because a corporation is going to have a lot more flexibility to write off things like education and other business expenses as a manager of that trading LLC, compared to if you just have that LLC and it's simply disregarded to you. So again, if you have that C corp as a partner within that LLC partnership structure, not only can you pay yourself a W-2 wage, you can set up a solo 401k through that corporation, maybe make some contributions to that solo 401k, all things that really kind of open up the option to do a lot more interesting things by changing the LLC to just being disregarded to you and having you as the only member, to adding your corporation as a member in that LLC, and running that payroll, those education, those 401k contributions through the corporation itself, and just having that corporation be the manager there.
That's right. It's a very popular structure that we have, the trading partnership for our clients who do a lot of trading. It's not for everybody. It does matter a little bit about what you have going on in your particular situation. So you certainly want to talk to our senior strategists and things like that to maybe get properly set up for something like that. But just as Kurt pointed out, many times one might incur some of these education or training expenses, and the typical general rules, you cannot deduct those. You can't deduct it on your personal return this is for a new line of business. You can't deduct it on your 1040 as a Schedule C sole proprietor. You couldn't do it through a partnership. So often what we will do, and really you're not supposed to do it through an S corporation either. C corporation is often the only way you can deduct it. So maybe, as Kurt pointed out, we set up a partnership, maybe have the trading activity in that partnership, and the C corporation is just one of the partners and you're the other one. Maybe you have 90%, C corp has 10. That allows you to get the education training taken care of through the C corporation, in which case it'll be deducted there where it's allowed to be deducted, because you can train your employees. You're allowed to do so on a C corporation, whereas you couldn't if you didn't have that. And then also, just from the trading activity itself, if you had $100 of income from trading and you didn't have that, well, all $100 is going to come to your 1040 on your personal return, all to be taxed, depending on what your tax bracket is, at the capital gains rates. But if we have that $100 being earned in our trading partnership, automatically $10 of that, or 10%, will go to the C corp, which is it's a 10% partner. So right there, we've saved 10%, or $10 in our example, from being taxed on your 1040. Now, $10 may not sound like a lot, but if that trading gain becomes 100,000 or more, that can be a significant amount of money that gets moved into the C corporation and kept off your 1040 to be taxed. Once that money is in the C corporation, as Kurt pointed out, there are so many deductions we have on that C corporation. Medical reimbursement plans. We had a couple questions today about those. You can get some of your medical premiums reimbursed, things like that. Trips to Mexico, if need be, for medical treatment. Co-pays. You go to the doctor. Doctor, you have to pay a copay to see the doctor. He or she writes you a prescription. You run over to the pharmacy. You have to pay a copay there. You can get all that reimbursed through the C Corp. All that through that money that was going to be taxed originally on your personal return. Now it's in the C Corporation. You have an accountable plan, which can give you a home office. If you have a home office that you're operating the C Corp for, you can be reimbursed for the costs related to that, based again on the percentage of the space that that office is taking up in the house. So some of your personal expenses actually can be reimbursed through the corporation, tax-free to you. All these reimbursements are tax-free. The medical reimbursement, accountable plan reimbursements, all money coming in your pocket, tax-free, and their deductions to at the same time to the corporation. Corporation also is required to have corporate meetings. Under Section 288, you can have some of those in your house as well. We want to make sure we abide by all the rules and make sure we're having actual meetings, et cetera, but it can pay you for that. All great ways to get that money out of the corporation back in your pocket tax-free, deduction to the corporation at the same time. Again, all from money that would have otherwise been on your 1040 if you didn't have that structure. And if there's not enough money in the corporation can be paid for its services that it's providing. In a partnership, we have a very special, unique item called a guaranteed payment, which is just paying the corporation basically for its activities. It's a flat fee. It can pay that in there, get more money into our C Corporation, and help cover those reimbursements that Kurt and I were just talking about. Again, medical reimbursement, accountable plan reimbursements for maybe a home administrative office or mileage or something like that. And then again, corporate meetings as well. So a really powerful plan. You run across a lot of these, Kurt?
Yeah. Actually, it's probably about every week that, we're having a discussion with a new client who's just either really doing well in the market. They've already been investing for a long time and they're looking for some benefits to kind of, take the edge off some of that investment income. Or they're just getting into, trading or doing covered calls or any kind of portfolio investing. And, they're just looking for the right structure up front so that they never kind of do it the wrong way and then, get their taxes filed and realize how much tax they're actually paying on that investment income. So you see it quite often, yeah.
And we just saw on one of our earlier slides that we have Clint and Toby coming up with that tax and asset protection, where we learn a lot about these tax tactics and structures and things like that. That's the trading. But what if Kurt, what if we also had some rentals out there? We've seen questions. We know we have a lot of clients with rental properties and all that. Can you use the same C Corporation to help out there?
Yeah, no, absolutely. There could be numerous ways to use a C Corporation. You can use it in the trading structure, kind of to manage your stock portfolio in this trading structure we were just talking about. That same C Corp could also be used to manage your rental properties. Maybe it's a short-term rental that you have right in that C Corp. Maybe you're just using that C Corp to manage your long-term rental properties. There's really a lot of things you could do with it. We even have clients that are flipping out of their C Corps. So if there's extra deductions that you can capture in that C Corp and there's multiple streams of income to that C Corp, there's really a lot you can do with it to kind of maximize the tax benefits of having those corporations. So they can be tremendously beneficial from a lot of different ways.
Very good point. And it also, being a C Corp, correct me if I'm wrong, Kurt, but it's taxed at a flat 21%. So, if we get any money in there and off of our 1040 and we were at the 37% tax bracket, at least we were able to save a little bit there as well. That could help out in the bottom line as well.
Yeah, absolutely. That low flat 21%. I mean, compared to someone who's, not only in the 37% tax bracket, maybe some of that income, depending on how it's earned, for example, they're doing flips, that might also be subject to self-employment tax. So not only are you saving 37%, or the difference between 21% and 37%, but also potentially the self-employment tax and potentially a lower state tax rate. So it can be tremendously beneficial.
Excellent. So as you can see, a lot of use. We can build these structures. We got, like I said, our senior strategist always out there tinkering, putting these things together. Toby and Clint are always out there, in things like the tax and asset protection class, handling, helping get that information out to you. So again, feel free to join that 15th and the 24th. All right, next, and I think this is our last question. When you pay your kids to work in your business, is this only allowed with a certain type of business structure, such as an LLC versus a partnership? A lot to unpack there. What do we got going on here, Kurt?
Yeah, so it is a lot to unpack. And the first thing to remember is no matter your business structure, you can always pay your kids to work in your business as long as they're doing things that you would pay regular employees to do. It can be a great way to shift income off your tax return or your taxes and shift that income to their tax bracket, potentially have them pay, little to no income tax on their side. So you can always pay your kids no matter your business structure. However, there can be ways to have your business structure be more efficient when it comes to paying your kids. Oftentimes depends on what your structure is, but oftentimes if we were to use simply a disregarded entity that was owned by husband and wife to pay the kids, that actually, depending on how much we pay them, if we pay them just up to the standard deduction, which I think is $13,950 in 2023, if I'm not mistaken. If you pay them just up to that point, not only are they going to get the benefits of that standard deduction, so essentially they pay no federal income tax, but if you pay them through a disregarded entity, also there might not be any payroll taxes associated with those wages. So, for example, if you already have a corporation like we've been talking about, you can potentially, instead of paying them directly out of the corporation, you can set up a disregarded entity, maybe have the corporation have a contract between the disregarded entity and the corporation for those services, pay the kids directly out of the disregarded entity, have them on payroll through, just run them payroll just like you would with any other employee. And then there would be no payroll taxes. So that's FICA, FUTA, potentially any state payroll taxes that are associated with that. Would not be subject to it if you did that particular way and paid them through the disregarded entity. Then the corporation just pays like a contracted fee to the disregarded entity to cover those costs. And then you've essentially paid your kids without incurring payroll taxes. And then as long as you don't pay them above the standard deduction, you've also made those wages without not subject to federal income taxes as well. So you might have to worry about a little bit of state income taxes depending on what state you live in. But overall, especially with clients who are in the higher tax brackets, 25, 32, 37, anything like that, it can be tremendously beneficial to kind of just shift income over to your kids, maybe get them started on a Roth IRA, things like that. So when they have that money, they can start investing that. Throw it in the Roth IRA or something like that, and then maybe they'll never actually have to pay any income on those wages ever. So could be tremendously beneficial way to shift income to your heirs.
Very good. And even if we can't, if we don't want to go through, or we don't want to go through the extra effort of setting up that separate LLC, as Kurt pointed out, you can pay them directly from your operating business if it's a corporation or what have you. That's certainly not a problem. The one thing to take away though, if we are trying to get the savings for younger children, under 17 or under, for saving on self-employment tax, they have to be paid as W-2. They can't be 1099. They must be W-2 employees of that entity. And that does have to, again, be maybe a sole proprietorship owned by one of the parents, or a partnership owned by both the parents, something of that nature. We could not do that, again, get that employment tax savings if we were paying them out of an S Corp or a C corporation, but still you can get benefit in that If we pay them under that amount that Kurt was talking about, the standard deduction, approximately $13,950 or thereabouts in that neighborhood this year for 2023, then they don't pay any federal income tax. So still a tax savings, but they would have to pay on the employment taxes. And if they're being paid out of a C corporation, other thoughts, because it starts to get a little bit more complicated when we throw in these different scenarios. But maybe mom and dad already have that set up, like we talked about in one of these previous C Corps that we've talked about in the previous questions. Maybe we have a solo 401k set up. Well, that should only have mom and dad as employees of the sponsoring entity. We don't want to bring the kids on as employees because that could change up what we're allowed to do with our solo 401k. We might have to get a standard 401k as opposed to solo. So maybe there you want to pay them as independent contractors if at all possible. There is a distinction between when we can call someone an independent contractor versus an employee, I believe, Kurt. Any ideas on that? I know we've talked about that in previous Tax Tuesdays before. Any idea when you're an independent contractor versus a W-2?
Yeah. So, independent contractor is really going to kind of function independently of the employer. So, it's certainly possible that your kids could be independent of you or your business. Kind of just set them up, give them a little bit more discretion on what their tasks are, give them a little bit more flexibility. Don't treat them like the rest of your employees, and just make sure you issue that 1099 at the end of the year instead of kind of doing the formal payroll. And you just claim them as independent contractors.
Exactly right. And a lot of different tests out there. You'll see the federal test for independent contractor versus employee, and there's maybe 17 different items on there. I think all of them, state or federal tests for this, one of the big criteria is the control. How much control do you exhibit over this individual, be it family or not? Are you telling them when to do it, how to do it, where to do it, so on and so forth? Or are they kind of independent? The more independence, the more they look like an independent contractor, as the name suggests. So keep that in the back of your mind, getting back to especially when we're talking about employing the kids, and just be aware of these things that while, yes, we can do these things, set up these structures, they can impact other things, such as a solo 401k example of having our kids on there. We may not have that accessible to us, the solo 401k, if we brought children on as employees. So we might want to think of different methods of paying them. But a lot of benefits to it, certainly, as Kurt went over. They can sponsor their own Roth plans and things like that. Start them at an early age. Maybe put it into, put it away for college later on or something like that. What are you going to pay them for? They can do any number of things. Social media is always a popular one. I know my sister's kids know all about that stuff. I know nothing. And so if I ever had something, I could employ them to try and help me out for marketing or something like that. Things. So great question. Love these questions. It shows that you're getting out there thinking about these different things, and very wonderful. And I think that was it for our questions for today. So just as a reminder, please check out the YouTube sites, Toby's and or Clint's, and I think Carl has one as well. Coffee with Carl, I believe, is on there as well. So a lot of Anderson YouTube stuff going on. Toby's here, as you can see. Feel free to click in there. He puts tons of videos up there. I love his facial expressions on a lot of them. And then moving on, of course, as we talked about, the tax and asset protection workshop, again, coming up here. It's online, free virtual event on the 15th of June, and again on June 24th. Really great event. You're going to learn a lot about the asset protection, and again, Toby's going to throw into the tax side and where the two meet. No better presenters of this material out there than Clint and Toby and Michael Bowman and our partners out there doing this. And again, it's just a way to give out to the clients some more free information. If you've already been there, encourage you to go again just to learn more. Some of the stuff you learn by repetition. So feel free to get in there. And again, we have other training items like structure implementation workshop or structure implementation series that you can, if you're a platinum client, you can find out more and get in there and learn about how it all runs at a more in-depth level and things like that. Free to you platinum clients. And I think that's all we have for today. Kurt, any last words? Oh, just as a reminder, if you have questions for the next Tax Tuesday come up in 2 weeks, please reach out to us by email, taxtuesday@andersonadvisors.com. Or you can just go to our main website, andersonadvisors.com. Any last words of wisdom there, Kurt?
I just want to thank everyone for joining us today. It was lovely to be on here and join in Elliot again. And hopefully we'll see you all in 2 weeks for the next one.
Absolutely. And just a thanks to our staff that helped out here. Again, we had Kenny and Matthew and Patty helping with all the tech stuff. We had, we got Dana, Jared, Lanzi, Ross, Tanya, and Troy answering those questions in the background. Thank you all for joining us. Always great to be here. It's a pleasure. And we certainly appreciate the opportunity to help with your questions, get those questions in there, and hopefully we'll be able to pick yours or at least one similar to it and help you out. Thank you so much.
Good day, everyone.